The economy and fresh signs of a looming recession. The GDP report out today, and it signals the U.S. economy shrank 0.9% at an annual rate in the second quarter. That's in line with pessimistic expectations and meeting a common but unofficial definition of a recession. That's all as the interest rate hike yesterday attempts to curb growing inflation in the country. It's a lot to absorb, I know. ABC News business reporter Alexis Christoforous, also ABC News senior White House correspondent MaryAlice Parks, both with us now to break this all down, what it means financially and also politically. Alexis, let's start with you. And what do you think? Does today's report tell you about whether the economy is in or very close to begin living in a recession?
Well, I think the answer is it depends on who you ask that question of. Certainly, we're seeing it play out in the political arena, the Democrats saying this is not a real recession, and the Republicans saying no, it is. But here are the facts. We saw the economy shrink 0.9% from April to June. And before that, the beginning of the month, from January to March, we saw the economy shrink by 1.6%. So the technical definition of a recession is two back-to-back quarters of negative growth. So now we have that. It is not a formal recession. But again, some people might say, what's the difference? If I'm feeling like I'm struggling and I can't make ends meet, it's a personal recession to me. And some economists I'm talking to say, we might be in what's called a sentiment recession. Maybe it's not a real recession in terms of the numbers, but it is a recession in terms of the way people feel about the economy and how they're changing their spending habits.
All right. Well, MaryAlice, we definitely know how Democrats and Republicans feel because we have heard from Nancy Pelosi and now we've heard from Kevin McCarthy, both with their different interpretation of where we stand right now. But President Biden did issue a statement on this GDP report saying that, quote, it's no surprise that the economy is slowing down. So what is the White House plan now to deal with this declining economic growth and also the growing inflation that Alexis and I have been talking about all morning?
Yeah, Kira, in that statement, the president's clearly trying to focus on the numbers that do still look good. He's trying to highlight the jobs numbers, the fact that consumer spending is still up, that foreign investment dollars are still flowing into the United States. He wants to say this is a complicated economic picture. And to that part of the statement you brought up, he's really focusing on the fact that the economy has gone through a lot of big historic shocks over the last few years with the pandemic. So he's saying, as you said there, that this isn't a surprise. There was always going to be some extreme growth and then decline as the economy kind of has to stabilize again after the pandemic. But look, he's also been focused in his economic policies on really the supply side of things. That's where we've seen him in policy proposals, what he's been rolling out, like the CHIPS bill that just passed in Congress over the last few days that really focuses on trying to get more money, more investment to develop semiconductors, sort of work on technology development, sort of bring more manufacturing here to the United States so there's less of a dependence on foreign pipelines for a lot of the technology that U.S. consumers rely on. And then obviously with some of the spending proposals that he's had around clean energy, he believes that that's working on supply. If you can help bring down and really boost production around clean energy, that lowers energy prices across the board. He says that that is really good for inflation. So really they've been focused much more on sort of trying to boost supply for the consumers without trying to harm some of these positive parts of the economy.
So, Alexis, how does this interest rate hike connect with today's GDP report?
Well, yesterday the Fed handed us the fourth interest rate hike of the year, and the intention behind that is they want to slow consumer demand, which has been red hot, especially because so many people have saved so much during the pandemic. They weren't out spending that money, and they were getting all of that economic stimulus, those stimulus checks from the government. So they were able to come up with a nice cushion of cash. Plus, we have a large part of the country working right now, right? We still have a very tight labor market. So they're trying to pull down consumer demand. They're hoping that that will pull the economy down a little bit and force these high consumer prices, the highest we've seen in 40 years, to start to come down. There is evidence that is starting to happen. We know that people are not buying houses at the rate they were because mortgage rates are now at their highest level in years. And consumer spending is slowing, but also shifting away from goods and more over to services. So the intention of those higher interest rates starting to trickle through the economy at this point.
All right, Alexis, MaryAlice, thank you both so much.
Hi, everyone. George Stephanopoulos here. Thanks for checking out the ABC News YouTube channel. If you'd like to get more videos, show highlights, and watch live event coverage, click on the right over here to subscribe to our channel. And don't forget to download the ABC News app for breaking news alerts. Thanks for watching.